Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed in for episode 245. And guys, today we're going to talk about every time this time of year we bring up that word called national deficit. Yeah, it doesn't mean much to a lot of people, but in this episode, I kind of want to explain what it means to mortgage rates, what it means to you, the consumer, and what it means overall for the health of our economy. All of that in this episode and more of What's Your One More. So, hey, let's talk about the national deficit. Obviously, we understand how that's compiled, right? A deficit is pretty simple when you spend more than the income coming in. And that's been a historical trend for us here in the United States, and it's continuing to go again as we're already over budget for the year of 2025. And a lot of the administration's working towards getting that fixed, but that's going to take time, and that's kind of seemed to be the motive of the tariffs to kind of put a dent in it. But in this episode, I want to talk about why it was downgraded. I want to talk about where it's heading, and I want to talk about why it's a potential issue. And more importantly, I want to talk about why that is impacting mortgages right now. We were on such a good trend, and then all of a sudden, tariffs, and then the pullback. Are we going to do it? We're not going to do it. Oh, Godzilla tariffs. Oh, we're going to talk it over with all these countries. We're going to work through it. And the loser in this situation is ultimately the consumer, because you've got rates that have dipped to a level that we called would be in the fives, didn't hang there very long, and now have spiked back up to significant levels, in the upper sixes, in some case lower sevens. And it's not fair to the consumer, right? And there's no control over it. There's a lot of things that aren't fair, but this is an unfortunate set of circumstances that is going to take a little while to dial it back. And, when you take a look at it, Moody's rating has now joined their peers of S&P and Fitch, and they've all come out and they have downgraded the U.S. debt now, which is basically treasuries, right? Because treasuries are a form of debt issued by the United States. And we know through listening to this episode and other episodes that treasuries are the main factor, especially the 10-year treasury, of deriving a 30-year fixed rate mortgage. I'm going to have a lot of charts in every episode. In this one, there's going to be two in particular, but they're important. And it's easier if you can see this on YouTube. If you go to our YouTube channel at What's Your One More, hit the subscribe button. You'll see this stuff in there and get a chance to take a look at it here. But, as I pull up my notes here, Moody's is downgraded from a AAA rating to a 1, to AA1, and that's the second highest rating that you can get. So it went from the highest rating to the second highest rating. And the reason I think that's important that we kind of talk about it a little bit is because Moody's commentary simply said, hey, listen, we're downgrading it one notch because we think this needs to reflect a couple things. Number one, it needs to reflect that a continuing issuing of debt in the United States and the lack of pulling back on spending are causing a little bit of concern. In 2011, S&P dropped it. They saw it at that time, and they haven't moved it back up. And then Finch's did it in 2023. Now you've got, their peer Moody's coming in, and all three of them have downgraded the U.S. debt. I think there's this notion that the U.S. debt and the U.S. dollar is untouchable because it's considered to be, the world's largest reserve, right? It's the currency reserve. It's crowned the world's reserve currency. And I think that, sometimes the U.S. debt is looked at as like this amazing unlimited credit card, right? It doesn't have a limit. It's gold, it's shiny, it's platinum, it's whatever you want to call it. It's a black Amex. You can't go wrong with it. And the reality is, I think the bond market has said enough. Like we've had enough of it, right? We realize that there's issues because the bond market has to continue to become increasingly attractable to buyers, right? So unlike going to a store, you go to a store and there's a product not selling, right? Let's use the laptop I'm doing with my notes here. If this laptop is not a good selling laptop, right? They produced quite a few of them in anticipation that it would be a world-class, amazing laptop, and it's not selling. As a consumer, we're saying, well, the price should come down. And that's what the supplier is going to do. They're going to reduce the price of this laptop, and we're going to go, oh, okay. Based on the reduction, is it worth it? Is it more attractive now? Maybe it's not. Prices go down again. Sometimes 20% off. Then it goes from 20 to 30. Then from 30 to 50. You get the point. And then it's on clearance, right? Everything must go. And we're not quite on clearance yet with U.S. Treasuries. That's not what I'm saying. But we're at that 20% sell right now. And unlike this laptop that I'm referring to where the price goes down, on a Treasury, to make it more attractive, the yield has to go up, which means the actual numeric number of the yield, the interest that you make on that has to go up to attract more buyers. That is a pitfall of not having enough people buying or enough countries and buying U.S. Treasuries, that there's oversupply of them. And I'm going to show you here in a minute where some of that oversupply may be coming from by lack of buyers. I want to be very clear about that. But the reality is that if there's not enough buyers and we have a surplus of these, the price has to go up. The consumer loses on that because ultimately that means the 30-year fixed rate is going to go up. Because We haven't had the Federal Reserve meet since the last meeting. They're not going to meet till June 18th. And at that time, they're going to make a decision to lower the Fed funds rate, which can alter and help that 10-year Treasury. But right now, we're not getting any relief. And I'll continue to say Scott Bessent has one of the toughest jobs in the world because he's got to find a way to get that number to come down, because he has said over and over again, one of my main goals, one of my main functionalities is to get the U.S. Treasury to 3.85. Well, I'll tell you right now, as we're doing this podcast here on Wednesday the 21st, that U.S. Treasury right now, when I pull it up, is 4.53. Actually, I'll take that back. It's 4.59, almost approaching 4.6. You're 80 basis points off of your goal. You've got some work to do there. And what sucks about that is he was there. He hit it, and we couldn't get it to stay there because of the back and forth on the tariffs and the market uncertainty. And we saw what happened to the stock market. The Trump called off the tariffs. For the most part, a lot of the reductions went away, put a 90-day pause on it with China. And it was like all that goodwill that was put in there, it all went away. And that really kind of sucks here, because it took the wind out of the sails when it comes to mortgage interest rates and the potential for home buyers to buy and people to refinance. Hopefully that will come back, but man, I'm going to have to pivot a little bit on our forecast here because of the Gonzalo tariffs that didn't hold, and the way they've kind of been yo-yoed back and forth, if you may, has caused a dynamic shift in what our forecast was, and we'll be doing that here in the next coming weeks, kind of pivoting on that, because again, we talked about in our forecast, barring certain economic windfalls, this was our forecast, and we even used the banking system in 2023 when we had Silicon Valley Bank go down, and that type of windfall we didn't kind of forecast how it altered the rate market. Here we are again, similar situation, different outcome, right? Or excuse me. Different situations, similar outcomes, what I should have said. And this is just unexpected things. So let's go back to this. Let's go back to the national debt. We're almost at $37 trillion. Like, I remember when I started this podcast just shy of 3 years ago, the first national debt episode we did, Charlie, I think was like at $32 trillion. 32. We said 32 going on 33. Remember that episode? 32 going on 32. Dude, we're at 37 trillion as I do this right now. We're not even 3 years removed from that. Kind of scary when you think about that at the rate in which it's going. We had a lot of good conversations on our YouTube channel at What's Your One More, back and forth, and on social medias, back and forth with people that were basically telling us it doesn't matter, and we were getting a lot of monetary theory put in there. But the reality is it does matter, and I'm going to show you this. In this graph that I'm about to pull up right here, it's called the sovereign credit ratings of the developed markets, right? And our friends MBS Highway gave this to us here. By the way, shout out to Dan Habib, about to be back on the show again. Love the fact he picked up the phone and said, hey, Q, I'd love to get back on the show. Would love to talk about a couple things that are real imperative in our market right now, and just get a chance to sit down with your audience and chop it up again. So can't wait to get him back on the show. But let's take a look at this here. So you look at this on our YouTube channel, you're seeing this graph I have pulled up here. So these are a lot of major countries, right? Australia, Canada, Denmark, Germany, Netherlands, Norway, Sweden, Switzerland, New Zealand, United States, Austria, Finland, South Korea, France, Ireland, United Kingdom, Japan, Spain, Portugal, Italy. That's a lot, right? But what you see next to them is all of their ratings from Moody's. And you can see how we have fallen down to mid-tier here. We're in the middle of the pack. Like, when you take a look at this, like, you think United States, like, you're thinking that top-tier rating. No. We are down in the middle of this now. And there's a number in here that I think is important, the public debt GDP ratio. Now, what this means is this is your debt to your income coming in, so an income ratio. It used to be thought of, I would say, as little as maybe 5 years ago, when you got to 125% of GDP to debt ratio, and they usually call it a negative. When you get to that level, it became like irrecoverable, is what people used to call it. A lot of economists said it was irrecoverable. I mean, it was such a drag on the economy that you couldn't overcome the debt, that the economy would actually hinder itself from growing. Since then, I would say over the course of the last really 2 to 3 years, that number's kind of jumped to 200%. And there's variable reasons as to why. But if you look at this, we're now at 123%. Among those countries I just named, there's only 3 that have that GDP ratio greater than ours, and that's Japan, Portugal, and Italy. Now, the reason that's important is because a lot of those countries are not in the best economic shape. We are far superior than that, but we are having some challenges of our own. And I think when I take a look at this, one of the things that's interesting here is that the minute this downgrade came out, we were at about a 4.4 on the 10-year yield. Now, as I'm talking to you right now, we're about 4.6. This happened less than 48 hours from when I'm doing this podcast. In the past, when this happened with Finches and when it happened with S&P, we had this bounce and then we had this recovery. Usually this recovery happened in the 10-year Treasury market like within the last 24 hours. We have not recovered from this, which is slightly concerning, and a reason why we're going to alter our forecast here. I would have thought we'd have hit 4.6, fell back down somewhere to that 4.4 mark where we started with this. We haven't seen that bounce yet. I'm not saying it won't come in the next 24, but we're way past the 48-hour mark of this happening. It's something that is concerning to me. Another thing that's a little concerning to me is that some of the Fed members have come out, especially, you know how I feel about Raphael Bostic, right? Charlie, I know we've talked about this on the show. I met this guy in person, and I was, I don't know, turned off would be the word, right? Smart dude, smart guy. But turned off in a lot of reasons I've talked about in the episode. I thought there was a little ego in the room there, more so than there was an educational and opinionated giving advice room. I was in a town hall meeting with him, and you can go back to the episode. I'm not going to dwell on it, but he did not impress me. And if you're listening to this episode, which I know he's not, I've invited him on the show 3 times, and I've gotten no response from his team. But and by the way, did you guys know this? The Federal Reserve is required. Each member of the Federal Reserve, they're required to have a team to answer those emails. And more importantly, they're required to come do educational forums like this. They have not done this one. So just a quickly reminder to them. But anyhow, and that's on their website. I'm not making that up or pulling that out. That's literally on their website. But the reality is, Raphael Bostic, he comes out and he says, hey, listen, we're not so much worried about the employment market as much as we are inflation. Well, wait a minute. All we've heard about is labor over inflation for quite some time. He's worried that literally the trailing trends of the tariffs are going to impact inflation over the next 69 days, that he only thinks there's going to be 1 rate cut this year. Well, good news for all of us here. He's not a voting member. So I'm not saying his opinion doesn't matter, but I'm saying his vote doesn't. And for that, I'm very thankful. Some other Fed members have come out and they have said, hey, listen, we see some potential issues to where there may be more than one Fed cut, 2, 3, or 4. But the one thing we know about the Fed is they change their mind rather quickly and they don't always adhere to their stances. But I will say this. I still think we're in the market for 5 rate cuts. I said at the beginning of the year, I think they may be in the combination of 50 versus 25, 25, 25, but I still think the overall number will hit as far as what we forecasted in due time this year. But let's get back to this GDP. So the other thing I noticed on here, as far as what's impacting the 10-year Treasury, there's a lot of rumors online. There is a lot of what I like to call social media talk. There's a lot of Twitter talk in regards to when we were in these tariff talks with China, that they were just immediately draining and selling and unloading their treasuries. And we talked about why that doesn't make sense. First thing was, if they're unloading treasuries before they mature, they're actually probably losing their behind on that. That doesn't make sense for them. They're losing money. You're not just going to do that for the hell of it, just to be spiteful, right? And the second thing is it doesn't make any sense for them. Where are they going to put the money, right? They still have to put that money somewhere where it makes sense for them to gain a yield. And, you know, as much as people think it's crypto or other things, don't get me wrong, that market may be doing much better than a 10-year Treasury. But from a safe haven standpoint, the reason you put money in a Treasury is because you're putting it in a safe haven so it won't have any risk tolerance. Literally, some of those other things I just mentioned have a tremendous amount of risk. You're not going to throw it over there. So my point is, they didn't just unload it to piss off the United States and drive the treasuries up. And the people online that are saying that are absolutely foolish. However, the second graph, again, go to our YouTube channel at What's Your One More. My buddy Dan Habib over at MBS Highway put this together. I love what he did here because he kind of said, hey, here's a couple things to take a look at. There's this enigma that countries are kind of backing off of the U.S. debt, being treasuries, and saying, hey, listen, we're scared, we're nervous of it, and there's been a lot of talk that other countries aren't participating in this. And foreign participation in the treasuries are critical to keep that yield down, right? Now, obviously, when you get downgraded, that doesn't help. And when there's not enough buyers in the market, that doesn't help either. Now, remember, we've talked about it over again. The number one buyer for years, the number one owner of all treasuries, is the general public and the Federal Reserve of the United States. And that's important. And they're slowly getting back into the market. They're not full throttle, but they're back in. They're got like a toe in the water. I need to put both feet back in the water. That's going to help out immensely as well. Take some of these treasuries off the shelf. But here's what we are seeing. Countries like the UK have been increasing their buying of treasuries, right? We see countries like Japan that are still buying. We see countries like Canada and Belgium, and we see Luxembourg and the Cayman Islands all increasing their positions in the treasuries. But what we also see on this graph is a downfall of China and their holdings. Now, the reason this is important, and this is why I think these notions online are popping up, because you can get access to the same graph I got. It just came from the U.S. Department of Treasury. There's a lot of people going, oh, man, look, they're unloading these. Look at the trend going down. And you can see it clearly. It looks like it's just falling right off. It's not going down. Like, I think that's important. It's not going down because they're unloading them. What you're seeing is how, I think everybody can understand that China was a large holder dating back to, the early 2000s of U.S. Treasuries. Those things are starting to mature. Like if they had 15-year treasuries or 10-year treasuries that they got in 2010, those are maturing. And they're falling off the books. I mean, you can see a cliff start to happen at 2020, but the peak was at 2010. That makes sense. 10-year notes are starting to mature. They're falling off. So the maturity date is happening and the coupons are maturing. They're not selling and unloading these. And so I think for the people online that are, how can I say it, not accurately describing what's happening is causing this false pretense that this country is retaliating against us over tariffs when that's not in fact the case. Now, because they're not repurchasing after that maturity, they're not saying, oh, these matured by another set of these. That is what's happening. And you can see that in this graph. They're not one-upping or re-upping that 10-year all over again. If they did, that would help. So their foreign participation is kind of diminishing a little bit. And that's not helping this either because they are one of the largest, top 4 holders of treasuries between them and the Fed, not being this buying powerhouse that they've been. That's kind of impacting us a little bit more than we'd like to see. And then add in this downgraded rating from Moody's, and we're 3 for 3 on the rating factors is kind of going from the best to the second best. And remember, I think there's 26 ratings that they can have on Moody's. We're at the second highest, so it's not like we fell off a cliff here. But the reality is the bond market doesn't like it, and the bond market is definitely rearing its ugly head, which is directly impacting mortgage rates. Now, good news is on the way, right? Every time you go and hit a height, there's only one way to go, and it's usually back down. And we've seen that. The question is, have we found that height, right? Have we found the top of where we can peak to right now, or is it going to get worse? I always think that there's this notion that how much higher can it go, And I think that for me, I think the 475 is the highest, right? I think that's where it's at. That's the high mark, right? And I think once we hit that, we peak. Hopefully we don't hit it, but we peak and we start to come back down. The question is, how fast can we come down? We got Scott Bessent, the U.S. Treasury Secretary, in our corner trying to get this thing down to 385. He's admitted that. He's got tactical abilities to do it. And then we need some help from the Federal Reserve. Like, they need to get it together over there, and we need to see that rate cut either be announced, put some confidence in the market it's going to happen, and then we'll start to see that cliff come down that we talked about. But between now and then, little choppy waters right now. Hopefully it gets better over the course of the next 48 hours. I'm not banking on it because we haven't seen that rebound that we normally see, but I do think help is on the way. It's just going to be a little delayed from what we originally thought. So guys, if you like what you're hearing, please share this podcast. Please give it a 5-star review on Apple or Spotify. You heard me say it about 4 times on the show. Check out that YouTube channel at What's Your One More. Subscribe. Leave some comments. Obviously, we love reading them. You guys' feedback is great. We always learn something from you guys on there. And for some of the people that like to argue, we even challenge you a little bit on there as well. We get into that with you guys in the weeds sometimes. Guys, I hope you have a great holiday weekend, and we'll see you back at the next episode at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put